Recently, David Rosenberg of Gluskin's Chef said, "What I'm seeing is the makings of a double top in the stock market." The firm's chief economist and strategist said Monday, "We are basically in the ninth inning right now, and it's not going into extra innings. So I say, you don't play the momentum." Rosenberg was concerned investors were taking on a lot more risk than they knew by pouring money into U.S. equities. Rosenberg believes more pain is coming. He stated that the markets are not telling you that we're in a new bull phase. They're telling you that we've gone back close to the high end of the range, he said. My sense is that we're going to roll off the high end of the range and go back and retest the low end of the range. He lists several factors supporting another leg lower. They include climbing trade tensions sparked by President Donald Trump's aluminum and steel tariffs, a more hawkish Federal Reserve, a ballooning budget deficit, and frothy stock market valuations. Among the first Wall Street strategists to turn bullish following the 2008 financial crisis, Rosenberg is drawing parallels between that period and the current one. He says, with each new high, investors are hearing the same thing: follow the momentum. Rosenberg further said, "These people that are telling you to play the momentum and to throw valuations in the dustbin, I got to tell you, I've been in the business for 30 years. I hear that close to every market top. You want to do the exact opposite right now, and you don't want to be the pig that gets slaughtered. This is the ideal time when the markets rally to take some profits off the table." According to Rosenberg, the signals are flashing late cycle, so it'll pay for investors to act more cautious. For investors who don't want to move entirely to cash, he recommends areas of the market that have been laggards. "I'd be more prone to getting out of these very whippy and flashy growth stocks and move more towards value." Rosenberg closed the interview by saying, "I've made a whole career out of not following the herd. I think that is basically just playing it safe." So let's take a look. So here's what I think Mr. Rosenberg is talking about when he's talking about we're in the ninth inning. I think his statement actually refers to we may be at the multi-year high. And using the 10-year monthly chart on the SPY, which is the S&P 500 ETF, as you can see, these two channels that I have taken the opportunity to draw on the upper and lower limits of the market's move from 2009, we sit now toward the high end of the range here. And I think Mr. Rosenberg is simply saying that, look, we're at the high end of the channel. Wait for some sort of correction for the market to fall back down to the lower end of the channel, which currently would be somewhere around this point here, I would say at about 230 as measured by the SPY. Now, I'm not quite ready to say that the market is going to turn over and have a crash, but I think that his statement is correct that this is now time to be cautious. Don't follow the market in the momentum. Don't buy the momentum because we're at the upper end of the channel. Wait for the reset down here. So now let's go to the next chart. And then this chart here from Mike Shedlock via Mishtalk. According to Mr. Shedlock, we currently are in this point here of this new paradigm chart. Going back here, we've been through the media attention phase up to enthusiasm, greed, and then finally the delusional phase to the peak of the new paradigm, and that we're now on the backside in the denial phase. And according to Mr. Shedlock, from this point here, we have about 67% to fall to the mean reversion line here. Now, Mr. Shedlock doesn't believe that this is going to happen, but he's still a lot more pessimistic right now than I am. But let's just carry through the logic here. If this chart is correct. In my opinion, we're probably through the denial phase, and that was a correction in early February down to this point here, which would be the bull trap or the sucker trap, and that we've bounced back up and we're in the return to normal phase right before the fear, capitulation, and despair phases. It is interesting that this chart here is somewhat similar to what I just told you in the previous video with regard to the parallels with 1929 and 1987, in that we have up until Wednesday of this coming week that we need to make sure that we can get through that. Otherwise, we might have a waterfall phase, which would be a significant downtrend. But even though I'm not this pessimistic about this chart here, or as shown in this chart here, I do have some concerns with regard to the current chart. So let's go to the last chart. And then this last chart here, which is the 6-month daily chart on the S&P 500 ETF Trust, or the spiders. And what's interesting here is using a more technical basis or traditional technical basis. I've drawn these trend lines, and some would refer this formation as a diamond formation, perhaps a pennant flag formation, but most often is probably called a wedge. And what happens in wedges is as it gets further and further toward this position here, the stock or the market gets squeezed, and then either the market pops higher or lower. And it looks like it's going to happen within this coming week or the following week at the latest. And so that is interesting for a couple of reasons. Number one, it's interesting because that this timing is somewhat consistent with, again, the previous video showing the waterfall sell-off of 1929 and 1987. So if it does head down, we're first going to look to see if it comes to this level or below, or here, the bottom of the correction in early February at this point here. If it gets beyond, sells off beyond this point in here, perhaps we're going to have a waterfall sell-off. If it pops up, we're going to be looking at this line here first, and then the previous high back in late January at this point there. So it's going to be an interesting couple of weeks coming up. So keep your eye out. For today, that's ChewDog Charts. Thank you.